Sam Altman just pushed OpenAI to a funding peak, only to be sued by his own sister. Is the sexual assault claim actually true? Bitcoin retail investors are being slaughtered at the highs, US regulation is a total mess, and prediction markets have exploded. Today's triple threat report on the crypto world. Friday, April 3rd, this is BitcoinTV Chinese channel, I'm Dong Dong. First, let's look at the most important data headlines from the last 24 hours. Lately, some dangerous signals have started flashing. Trump signaled a possible escalation of military action, and the market immediately turned to safe havens. Oil prices hit $111, the dollar strengthened, the VIX hit 25, and liquidity is clearly tightening. The problem isn't sentiment, it's structural. CME Bitcoin futures open interest has reached a high of 180,000 to 200,000 BTC, mostly concentrated in the 1 to 3 month range. Simply put, current prices are mostly driven by leverage rather than spot buying. This structure is very sensitive. Once external pressure hits, it's easy to trigger a chain of liquidations. A normal correction of 25 to 30% is common, but if funds keep withdrawing, it could be even larger. The core logic is simple. Bitcoin is still a liquid asset. Once money tightens, leverage amplifies volatility, and this high CME open interest acts as a risk amplifier. The Binance taker buy-sell ratio soared to 1.29, showing retail investors were frantically chasing the rally at $68,000. This indicator looks at the active buy-sell ratio. The higher the value, the more people are chasing the buy. But as the environment changed, oil prices rose, the Nasdaq weakened, and ETFs saw $170 million in outflows. Bitcoin dropped to $66,220, down 3.26%. All that capital chasing the rally is now trapped. Even more painful is the institutional attitude. Coinbase's Z-score is around 0.35, still on the sidelines, while Binance is at negative 1.46. Retail liquidity is being drained, and capital on both sides is completely misaligned, forming a crocodile mouth, with retail trapped in the middle. Derivatives are also cooling off. Open interest dropped from $21.66 billion to $21.47 billion. But the key signal is the funding rate turning negative to 0.0014. The SSR is around 10, and stablecoins are still building momentum. This isn't the end of the trend, it's a leverage flush. Once institutional funds flow back in, this structure is actually prone to triggering a short squeeze, and the shorts will be blown out. CryptoQuant CEO Ki Youngju has made it clear, right now it's the smart money that's absorbing the supply. On-chain data is also straightforward. The Binance BTC CVD confirmation score hit 0.77, a new high for the year. This indicator looks at one thing, whether the buying pressure is actually supporting the price. The current picture is somewhat counterintuitive. The price is still hovering between 60 and 70,000, but this score is surging, meaning someone is really buying and doing so quietly. This is what we call silent accumulation. Big money isn't pumping the price, they're just slowly absorbing it from below. The structure is clear. Short-term is exiting, spot is entering, and selling pressure is being absorbed. Historically, this situation is like holding one's breath. Once released, it usually leads to a trend, not just volatility. Please like and hit the bell. We're monitoring the news for you 24 hours a day. Bitcoin is still fluctuating between 66,000 and 69,000, but the market focus has shifted. OpenAI CEO Sam Altman is in a new legal dispute. His sister Annie refiled her lawsuit on April 1st, bringing it back to court. Crucially, on March 20th, the judge ruled some claims were past the statute of limitations, but allowed refiling under Missouri law. Now the case has been revived. The timing is critical, as OpenAI just finished a $122 billion raise with an $852 billion valuation.
According to public documents, Annie Altman's statements involve childhood allegations occurring at a residence in Clayton, Missouri. The case faced dismissal over the statute of limitations, but Judge Zachary Bluestone allowed refiling under Missouri's child-related laws. This law provides special exceptions for historical allegations, creating a legal path for the case to proceed to trial.
Sam Altman's stance is clear. He denies the allegations and has already filed a countersuit for defamation.
In court filings, Sam Altman's legal team stated the allegations lack factual basis and questioned the underlying motives. The Altman family simultaneously released a statement in response. The judge's March 20th ruling allowed the countersuit to proceed, meaning a long process of evidence and litigation lies ahead.
The impact of this lawsuit goes beyond the legal realm. It's also about the dimension of time. A year ago, few linked Altman to such risks. Now this shadow looms over a massive funding round and high valuation. More importantly, the final outcome of the case won't be settled until 2027 or even later. During this time, public opinion, investor confidence, and internal company stability will be continuously tested. For someone at the top of the industry, this kind of long-term uncertainty is a significant pressure in itself. The story of the prediction market is actually quite ironic. With AI's arrival, it cooled from a hot topic to lukewarm. While traders remain active, public interest has largely faded. However, this week saw a reversal as the DOJ and CFTC sued 3 states, pushing the topic back into the spotlight. It seems like a matter of popularity, but it's not. The key is that it's being redefined. Is this a financial product or just a form of gambling? Once a niche, monthly volume is now $21 billion. Major platforms are joining and regulators are taking sides. The most critical question now isn't whether it can be done, but who will set the rules.
The U.S. Department of Justice and the CFTC have officially sued Illinois, Arizona, and Connecticut.
The core dispute is that state governments are trying to treat prediction market platforms like Polymarket and Kalshi as high-risk betting businesses, whereas the federal government's view is entirely different. The feds believe these products are essentially event contracts and should be under the unified oversight of the CFTC.
These contracts reflect that they go through a very stringent process of self-certification. They can't be readily susceptible to manipulation. We surveil those markets. We police things like insider trading.
The global prediction market has reached 85,000 active markets, with a clear concentration at the top. Polymarket's 2025 trading volume was about $21.5 billion. Kalshi's was about $17.1 billion, and April alone saw about $21 billion. The two paths have diverged. Kalshi holds a CFTC license and focuses on macro contracts, with a year-on-year growth of about 300% in April. Polymarket focuses on sports and cultural themes, targeting retail investors. The third tier, such as Fanatics Markets, Predicted, and Metaculous, are positioned in sports, politics, and research, respectively. But in a regulatory environment, different paths face the same constraints. The core issue lies in the definition of legal identity. Prediction markets are a bit like a player who just got over a fever, pushed forward by AI for the past 2 years. They've now realized they haven't even learned the rules yet, and regulators are already at the door. Next, there are basically 3 paths. One is to take the straight path, working hard to get licenses, doing risk control, and pushing into the financial system. Another is to continue opening up, expanding through liquidity and hot topics. But the pressure will also get bigger and bigger. And there's another path, a middle ground, opening only a part of it, which is essentially a version incorporated by regulators. But the real trouble is AI. While it's helping you with risk control, it's also creating noise. Once information is contaminated, the logic of collective judgment will fail. In the end, what it comes down to is quite simple: whether rules can be unified, whether the market can prevent manipulation, and whether users can be protected. If successful, it's a new financial tool. If not, it'll be reclassified as gambling and then phased out by the market. Musk's X launched identity verification to prevent scams, while Durov's Telegram countered by opening perpetual contracts. It's a clash of philosophies between the two platforms. Adobe was hacked, with 13 million pieces of data completely drained. Security can only ever survive as long as its weakest link. This is actually quite interesting. The two major platforms have started a direct values-based spat. Musk's X is where global big shots speak out, while Pavel Durov's Telegram is the home base for the crypto community. As a result, on the same day, one said, "User, I trust you," and the other said, "Sorry, I don't trust you." So one started granting financial permissions, while the other countered by locking down. For these two products, this isn't a feature upgrade, but a battle of philosophies. X has launched a new anti-fraud mechanism this time. As soon as an account posts crypto-related content for the first time, it will be locked by the system and required to verify its identity. This is mainly to prevent accounts from being stolen and used to impersonate celebrities for issuing coins. Product lead Nikita Bia also mentioned that the problem isn't actually with X itself, but with phishing emails in Gmail. That's the entry point for the entire scam chain. So, relying on just one platform isn't enough. Multiple stages need to work together.
A top priority I would have is eliminating the spam and scam bots and the bot armies that are on Twitter. Yep, you know, I think that these fund influence they make the product much worse. If I had a Dogecoin for every crypto scam I saw,
And this time, Telegram has put the exchange directly into the chat box. Perpetual contracts are live with Lighter as the base. Over 50 assets, crypto, stocks, oil, gold. It's all there. Up to 50 times leverage, trade with just $1, plus built-in take profit and stop loss. The key is its 900 million users, a scale larger than many exchanges. This means you can open positions while chatting without even switching APPs. Looking deeper, this isn't just a product update, it's two different philosophies clashing. Durov's side follows the Web3 logic: open the doors first, give power to the users, and let them decide how to use their money and handle risks. Sounds very free, doesn't it? But the problem is most people actually lack that judgment. Musk's side follows traditional internet logic: guard the door for you, set the rules first, and keep risks out as much as possible. You get security, but freedom is also restricted. Simply put, it's a disagreement over three things: who controls the entry, who bears the risk, and whether the platform is a tool or a referee. What's more interesting is that these two combined have nearly 1 billion users. Every move they make affects the money and behavior of a massive global population. So in the end, it's not about who has more features, but who can find a balance that doesn't cause too much loss or over-regulate people. Adobe was hacked, which isn't exactly news. Big companies have issues every week, but the key this time wasn't Adobe itself, it was their contractor. The hacker, Mr. Reckless, didn't touch the core system. Instead, they targeted a BPO customer service firm in India. A phishing email and a remote control tool opened the door. As a result, 13 million support tickets and 15,000 employee records were stolen, and even the vulnerability report database was emptied. The whole process was like not even entering the vault, but just waiting at the door for the keys to be delivered. The issue is simple. Your security isn't defined by your strongest point, but by your weakest link, the outsourcing stage. And often, you have no control over that link at all. The attack path perfectly matches the logic I just mentioned. Start with people, phish an employee, plant remote access, and then phish a supervisor for higher privileges. But the real problem isn't the attack, it's the system design. Once inside, the customer service system allowed a one-time export of 13 million data points, with no rate limits, no anomaly alerts, and no extra verification. The result was that one person's mistake was amplified by the system into a full-scale data breach.
We've seen this rise of social engineering and phishing over the last couple of years. As I mentioned a minute ago, they're still the #1 cybercrime, but now any petty criminal can use ChatGPT. They can send emails and...
What's even worse is that HackerOne data was stolen, including unpatched vulnerabilities, system weaknesses, and internal structures. Basically, a complete attack map. This kind of information can be used for secondary attacks, extortion, or even resold. On the surface, it's a customer service breach, but essentially, core risks were exposed all at once. The issue isn't a single point, but the entire security chain. Once one link is broken, the impact is directly amplified to the system level.
This is also a more realistic concern for Web3 and crypto projects. Many projects tout decentralization and security, but in practice, they still rely on outsourced development, community management, and third-party tools. Supply chain attacks come from these places. They don't need to hit your core, just your weakest link. The key isn't why Adobe was hacked, but whether your system has the same entry point. When you outsource permissions, store data with third parties, and hand over keys, you're essentially giving your security to someone else. Security isn't a module, it's a whole chain. If even one link isn't in your hands, the risk is always there.
DOT is onto something. The SEC and CFTC classified it as a digital economy asset, putting it on par with Bitcoin and Ethereum. Plus, with the staking upgrade in April, unbonding drops from 28 days to just 1 or 2, making funds much more flexible. For institutions, this is a signal that it's time to enter the market. ONT surged 50.9% in a day, hitting $0.119, a new high for the year. This was mostly driven by sentiment, but it shows capital is starting to flow into low-priced altcoins. This kind of market comes and goes fast. Chasing highs can easily leave you trapped. On April 1st, the OCC's new rules took effect, allowing national trust banks to provide digital asset custody. Simply put, regulators are giving the green light for traditional finance to take over this business. Crypto assets are gradually moving into the mainstream system. Chainlink has also stepped up to support the Clarity Act. This is the crypto market regulation currently being pushed by the Senate. The key isn't just one project speaking out, but the industry starting to band together. This shows that regulation isn't just talk anymore, the rules are likely to be finalized. Aave introduced a new architecture at ETHCC 2026 specifically for RWA and structured credit. Simply put, DeFi is no longer just playing with itself, it's starting to bridge real-world assets, which is the start of true adoption.
The hottest topic in the last 24 hours is simply this: AI is accelerating stratification. You'll see that it's not everyone being replaced, but those who don't use AI being replaced by those who do. Many people are anxious because they're still using old-school effort to fight against new-age efficiency. It used to be about time, now it's about insight. It used to be about execution, now it's about judgment. What really sets you apart isn't how much you can do today, but whether you can make tools work for you. You don't need to become AI, but you must learn to use AI, because future competition isn't between people, but the gap between human plus AI and human plus AI. The sooner you upgrade yourself to a decision maker, the less likely you'll be pushed out. Remember, those who don't use AI aren't just slow, they're being phased out. Alright, that's our deep dive for today's show. Our channel is always focused on core narratives and value discovery in the digital asset space. If you agree with our logic, feel free to stay updated and turn on real-time notifications. To access higher-level research reports, you can follow our advanced channel. From Monday to Friday, I'll share my deep reviews of market cycles to capture certainty and opportunities within trends. See you tomorrow.